There is a number that gets used to end this argument before it starts. The median American homeowner has a net worth of about $396,000. The median American renter has about $10,400. That's not a small gap. That's 38 times. And every single time someone tells you renting is throwing money away, that number is what's sitting underneath it. Buy a house, build wealth, rent, and you're handing your landlord a life you could have had. But that number doesn't say what people think it says. And by the end of this video, you're going to understand exactly why. Because the real math of renting versus buying is not the math anybody shows you. We're going to run it. A real house. A real mortgage. Real property taxes, real maintenance, real closing costs. Against a real renter who does one specific thing with the difference. And the result is going to be much, much closer than you expect. Let's start with the house. $400,000. That's roughly what a normal home costs in America right now. You put down 20%, $80,000, and you borrow the other $320,000 over 30 years at 6.5%. Your monthly payment on that loan is about $2,023. That's the number that goes in the ad. That's the number your friend quotes at dinner. And it is nowhere near what the house actually costs you. Because that payment is only the loan. It doesn't include property tax, which on a $400,000 home runs around $367 a month. It doesn't include homeowner's insurance, call it $150. And it doesn't include maintenance, the roof, the water heater, the furnace, the thing you didn't know existed until it broke. The standard estimate is 1% of the home's value every year. On this house, that's another $333 a month. Added up, $2,873 a month. Not $2,023. $850 a month more than the number in your head every month. For 30 years. And we haven't even opened the front door yet. Closing costs to buy are usually 2 to 3%, so knock another $10,000 off before you own anything. Now here's the part that genuinely shocks people. Look at your very first mortgage payment. $2,023 leaves your account. Of that, $1,733 is interest. Money that goes to the bank and never comes back. $290 actually buys a piece of your house. 86% of your first payment is rent. You're just paying it to a bank instead of a landlord. Over your entire first year, you'll hand over about $24,300. Roughly $3,500 of it becomes yours. The rest evaporates. And across the full 30 years, if you never move and never refinance, you will pay about $408,000 in interest alone. On a $400,000 house, you pay for the house twice. Once for the seller, once for the bank. So that's ownership, honestly costed. Now let's build the other side properly. Because this is where almost every video on this topic cheats. Our renter finds a comparable place. Same neighborhood, same kind of home. $2,000 a month. Notice what the renter does not pay. No property tax. No homeowner's insurance. No maintenance. When the water heater dies at 2 in the morning, it's a phone call, not a $4,000 problem. No closing costs. No realtor. So the renter is spending $873 a month less than the owner. And crucially, the renter still has that $80,000 down payment, plus the $10,000 in closing costs they never paid. $90,000 sitting there. Here's the rule that makes this a fair fight. The renter has to invest all of it. The $90,000 goes into a broad index fund on day one, and every month the $873 difference goes in too. If the renter spends that money instead, this comparison is over before it begins, and the homeowner wins by a mile. Hold on to that, because it's going to matter enormously in a few minutes. 10 years pass. Let's see where everybody actually stands. The homeowner first. American home prices have risen roughly 4% a year over the long run, so after 10 years, the $400,000 house is worth about $592,000. That sounds fantastic. But you don't own all of it. You still owe the bank about $271,000, because in the early years you were mostly paying interest. So your equity is around $321,000. Except you can't touch that money without selling the house, and selling costs about 6%, realtor fees, transfer taxes, the whole thing. That's roughly $35,000 gone at the door. The homeowner walks away with about $285,000. Now the renter. That $90,000 invested in the market at a long-run average of about 8% becomes roughly $194,000. The monthly difference is trickier, and I want to be honest about it, because rent goes up and a fixed mortgage payment doesn't. In year 1, the renter has $873 a month to invest. By year 10, after rent increases, that surplus has shrunk a lot. Averaged across the decade, call it $600 a month invested. That grows to about $110,000, total for the renter, roughly $304,000. $304,000 for the renter. $285,000 for the owner. After 10 years, using completely standard assumptions, the renter is slightly ahead. Not dramatically. Not enough to build an identity around. But the person who was throwing money away ended the decade with more money than the person who was building wealth. So why does that 38 times statistic exist? We'll get there. But first, 3 things actually decide this, and they matter far more than your opinion about houses. The first one is the price-to-rent ratio, and it is the single most useful number in this entire debate. Owning a home has costs you never get back: property tax, maintenance, insurance, and the return you gave up on your down payment. Add them together and they land near 5% of the home's value every year. So here's the test. Take the price of the house and multiply it by 5%. If a year of rent on a comparable place costs less than that, renting is genuinely cheaper, and the gap is your profit if you invest it. Our $400,000 house times 5% is $20,000 a year. That's $1,667 a month. Our renter is paying $2,000. So in this example, renting is actually slightly expensive, and buying still nearly ties, which tells you how powerful the leverage on a mortgage is when prices rise. But in an expensive coastal city, where a $900,000 house rents for $3,000 a month, that same test says renting wins by a landslide, and it isn't close. In a cheap Midwestern town where a $200,000 house rents for $1,800, buying wins overwhelmingly. Same country, same year. Opposite answers. It was never a national question. The second thing is how long you stay. Buying and selling a house costs roughly 8 to 10% of the price. Round trip. You have to stay long enough for appreciation and equity to dig you out of that hole. For most people, that break even is somewhere between 5 and 7 years. Which leads to the cleanest rule in this whole video. If there is a real chance you'll move within 5 years, buying is usually the more expensive choice, no matter what the market does. Not risky. Just more expensive. And the third thing is the one that explains that opening statistic. Because here's the truth about our renter. That renter is a fictional character. Everything we just calculated assumed a person who invests $873 every single month for 10 years and never touches it. Not in a bad month. Not when the car breaks. Not when the market drops 30% and every instinct screams at them to stop. Almost nobody does this. The American personal savings rate sits around 4 to 5%. The overwhelming majority of renters do not invest the difference. They spend it, exactly the way everybody spends money that isn't already committed. And that is what a mortgage really is. It is a savings plan with a legal contract attached and a serious penalty for skipping a month. It is bad math wrapped around brilliant psychology. The homeowner didn't get rich because real estate is magic. The homeowner got rich because they were forced to save for 30 years, and the renter was free not to. So here's the honest answer. On pure math, renting and investing the difference is competitive with buying, and in expensive cities, it wins clearly. On human behavior, buying wins most of the time, because it removes the decision from you. Which means the real question was never rent or buy. It's this: are you the kind of person who will actually invest the difference, month after month, for a decade, with nobody making you? If the answer is genuinely yes, run the price to rent test on your own city and let the number decide. You've just seen how. If the answer is no, and for most people it honestly is no, then a mortgage isn't a bad deal. It's a commitment device you're buying on purpose, and it's worth the premium. Just don't buy it believing renting was throwing money away. It wasn't. It was a choice with a cost, exactly like the other one. And now you can actually see both.